Hey everyone, I wanted to throw together a little video on dealer gamma dynamics. So don't get scared by that title. Basically, there's a lot of talk of dealer gamma these days. Are dealers long gamma? Are they short gamma? And all that really means is, if I explain it simply, it's just basically dealers being long a lot of options is to be long gamma. Dealers being short gamma is to be short a lot of options. Net, right? They might be long some and short way more, so then they're short gamma. And what that means is they have a hedging dynamic that actually pushes stocks around when they're short gamma. And so I'm going to show you a little bit of what that looks like in terms of a gamma map. I'm going to tell you what it means. I'm going to show you how the mechanics of the situation work. And then what does it mean specifically for NVIDIA here. So let's take a look. This is the map of dealer gamma in NVIDIA right now. So out about 6 months, they have sort of an aggregate amount of options that they are either long or short. So in this case, it shows that they're quite short a lot of options from the 115 strike out to the 125 strike. So now how does that happen? Well, it happens simply by customers coming in and buying, lifting a whole bunch of calls off of them. So a customer comes in, buys 100 or 1,000 calls at the 125 line for November. Dealers got to sell those calls. They end up hedging with stock, maybe some other options, maybe some other structures, maybe other mags, whatever it might be, other semiconductors. We don't know exactly what they do, but typically they're going to probably just buy stock, NVIDIA stock, in order to hedge that exposure. And I'm going to show you the math behind that in a moment. So basically, they're being forced to sell a lot of calls effectively as people start to look for this semiconductor trade to come back. And of course, NVIDIA is the sort of general of the bunch, the leader of the bunch, and they're going to come after that stock especially. And they're forcing dealers into selling quite a few calls, and that's leaving the dealer short a lot of gamma. And what that means is they could potentially, if the stock starts to move higher, and that this may be part of the reason it is moving higher, is that they need to buy stock. So there's a whole bunch of people needing to buy stock. Add that to the natural flow of a stock into the market, of demand from the market, which is already pushing the stock up, and some positive comments from Jensen and some other characters this week that basically said, look, this is huge and it's not going away, and it is massive. The demand for semiconductors is absolutely massive. So that put to rest some of the concerns that were out there recently, which is people are spending a whole bunch of money on this stuff and maybe they're not going to get a sort of return on investment for a long time, if ever. And so it started to make people a little bit nervous about this sector. The comments this week in that conference basically bolstered the idea that this is earlier innings rather than the beginning of potentially a downturn in capex. So it's lit a fire under these stocks. Hedge funds have really de-risked in that area, so they may have to re-risk and regross, basically buying back a lot of these names that they haven't owned for many months. So if that's the case, we have all this pressure coming into the market, as well as customers buying upside calls for this potential upside in NVIDIA. And what does that mean? Well, all these dealers are short calls, and I'm going to show you the math on how that works right now. Okay, so now this has to do with market makers, right? When I say dealer, it could mean market maker a lot of the time. I was a market maker for 12 years, so I understand how this works. Now, I'm going to show you a scenario here. The customer with NVIDIA at, say, 118 bucks, customer comes in and buys 100 of the October 125 calls in NVIDIA. Who sells it to him? Sometimes there's a customer who will sell those calls to the other customer. That happens sometimes. It's a very liquid market, so there's a little bit of everything, but a lot of the time it's a market maker providing the liquidity in this particular product. So the dealer sells the 100 calls to the customer. Now the stock's at 118, so let's say the delta on these calls is 35. So the dealer, in order to neutralize their risk, the dealer has to buy 3,500 shares, right? How do we figure that out? Well, it's the delta times 100 calls times 100, right? Because each call, it gives us the right to buy or sell, gives us the right to buy 100 shares. So we have to multiply the number of contracts by 100 to get the sort of notional stock that we're talking about here, which is 1,000 shares times 10,000 shares equals 3,500 shares. So to go delta neutral, to neutralize their risk, they're basically, if they sell these calls outright, if NVIDIA goes up $1, they stand to lose $3,500. What can they do to neutralize that? Well, our delta helps us do that, right? Delta is an extremely important option Greek that we teach in all the programs. You need to know about delta. So they're going to buy 3,500 shares to neutralize that risk, meaning up or down $1 shouldn't hurt the dealer, assuming all else equal, right? Implied volatility isn't moving around and all this kind of stuff. So what happens when NVIDIA goes to 125? Well, the delta is now 50 on these calls, right? The delta's gone from 35. They had a smaller likelihood of being in the money when the stock was at 118. Now the stock's at 125. Do they have a higher likelihood of being in the money? Yeah, they've got about a 50-50 shot at being in the money. So that's a 50 delta. At the money's deltas are generally going to be right around 50. So what does the dealer have to do? Well, guess what? They're under hedged by 1,500 shares because they should be long 5,000 shares to hedge to delta neutral, right? If they want to take risk off the table, because at 125, these calls are now going to act like a 50 delta. They need to be ready for a move up in the stock. With 3,500 shares, they are under hedged at this point. So they have to go out and buy 1,500 shares. Now they may buy a few at 121, 123, 125. That's fine. But the net result is they need another 1,500 shares. So what's happening here? NVIDIA is going up, and dealers that are short NVIDIA calls are having to buy stock into the rally. That exacerbates a rally, right? This is how negative gamma can affect a stock. It affects the movement of the stock. The customer is just sitting there. They're not selling stock against these calls. Most of them, I mean, some people are, right? If you're institutional or you're a pro trader, or maybe you're selling some stock, but most of the clients that own these calls are just waiting for these to go up, and at some point they'll sell them. So the dealer, though, has to consider risk every single day, right? They're managing risk. They're managing their exposure and their risk on a daily basis. They have people to answer to. They have a P&L that calculates throughout every day. So they have to be accountable for their actions. So they're going to buy 1,500 shares. Okay, now they're long 5,000. What if NVIDIA goes to $135 at that point? These calls are now a 75 delta, maybe even an 80 delta. Let's say an 80 delta. Is the dealer hedged enough? Are they overhedged or underhedged? Well, they're long 5,000 shares. What's an 80 delta times 10,000? It equals 8,000 shares. They're underhedged again by 3,000 shares. So from 125 to 135, they need to buy another 3,000 shares. Well, guess what? That's buying into strength. So can you see how negative gamma from a dealer's perspective, from a hedger's perspective, is pushing NVIDIA up as NVIDIA goes up? And what if NVIDIA turns around and now goes from 135 to 120? 135 to 120. What's our delta? Well, our delta is no longer 80. Our delta is back down to, especially if time has passed, the delta is going to be even lower than it was before at 120. So the delta now is, say, 25. The dealer's long 8,000 shares, and they should only be long 2,500 shares, because a 25 delta times 10,000 equals 2,500 shares. That's all they should be hedged. So on the way down from 135 to 120, the dealer is now scrambling to go the other way. So they're taking a loss probably on all this stock that they bought on the way up. They bought all the stock on the way up. Now they're having to sell on the way down. Now, the benefit to the dealer is they're short gamma, they're short options. There's a theta decay there, right? So they're benefiting from the erosion of the value of the time value of these options, assuming implied vol hasn't overcome a lot of that decay. Eventually, the decay it is what it is, right? We know that options have to be worth, intrinsic, zero, or they're going to be worth something or nothing by the end of expiry. So, vol can go up in the meantime, but eventually it's going to all come out in the wash. But now there are other, further lesser known Greeks that you can deal with, Vanna and Charm, and the effect on delta with the passing of time, the effect on your delta with a rise or a fall in implied volatility. These are going to come into play as well for the dealer. So this is not a fun situation, right? Things are swinging all over the place. Volatility is moving around. Your delta is moving around like crazy because of all these multiple dimensional things that we talk about that we can explain with Greeks, and especially the secondary Greeks. But there's a lot going on here for the dealer. But the whole point of what I'm showing you here is that on the way up, dealer gamma, negative gamma, and not just dealers, for anybody who's trading, could be hedge funds, whatever it is, you're short, maybe they have to hedge on the way up, which pushes the stock up, and then on the way down, it pushes the stock down. So this creates volatility that is, only added to the other volatility that's already out there in markets. NVDA being such a large market cap and such an important stock. Yesterday, NVIDIA was 44% of all options traded, if you can believe that. 44% of all options traded were NVIDIA options on a massive update in the market. So this is big money. These are huge flows. But the point is that you have all these flows, and you have flows as well from these ETPs that need to buy into rallies and sell into sell-offs in order to rebalance their exposure, right? These ETPs that are long and short NVIDIA, multiple amounts, inverse products, all these kinds of things often have to rebalance in the direction of the stock. So that also creates an imbalance of supply and demand, which can exacerbate moves. So this is some of what we're seeing out there. Dealer gamma is probably more of an issue than it ever was. You look at the increase in option volumes over the last 10 years, especially the last 5 years, massive amounts of options being traded these days. So these things have become more important than ever, and they're things that you want to pay attention to and understand. So I hope that helps you guys a little bit. These are interesting times, a lot of crazy stuff going on, and it's always fun to talk about them. And if you guys have any questions at all, reach out to me or leave a comment below. And you can also check out our programs. We've got this 4-day option trading challenge, completely free. You're going to learn a lot of really cool stuff like this, a little bit different, but like this, in terms of how our option selling system works. Check that out, and then let me know in the comments what you think, and reach out to us at crushthepremium.com, and we'll see you guys next time.